Invest in equity funds only if you can invest for a long term to navigate the risk and earn decent returns. As new investors, you must have heard this multiple times. But what exactly is long term? Is it 5 years, 10 years or more? And more importantly, is the definition of long term same for large cap, mid cap and small cap funds? Hello and welcome to our channel 5-Minute Finance by ET Money, where we discuss the basics of investing and personal finance. In this video, we'll answer a very common and relevant question for a new investor. How long should you invest via systematic investment plan or SIP in an equity fund to earn double-digit returns? And how are we going to do it? Let's understand the methodology. So ValueMetrics has done an amazing study. It looked into the rolling SIP returns for different SIP tenors, 5 years, 8 years, 10 years, 12 years and 15 years over a 20-year period between April 2005 and March 2025. Now let's understand rolling SIP returns with an example. So 5-year rolling SIP returns over a 20-year period means monthly SIP returns for all the 5-year periods that existed in the 20-year period between April 2005 and March 2025. And by taking an average of all those returns, we get rolling SIP returns. Now, since the rolling returns are based on a large sample of historical returns, we can rely on them to some extent to help with our investing decisions. Now, let's get started with looking at how long to invest to earn double-digit returns. We'll start with large cap funds. Large cap funds invest at least 80% of their assets in large cap companies that are the top 100 companies in terms of their size. Now, as they invest in the largest and the most stable companies of the country, they are often considered as the safer bet across equity fund categories. So, if you are a conservative equity investor and want to invest in large cap funds, how long should you invest to earn double-digit returns? So, look at the data on your screen. SIPs in Nifty 100 TRI, a popular large cap index held for 5 years, had a 99% chance of positive returns. But the minimum return could go as low as minus 4.9%. And only 79% of the times, 5-year SIPs delivered more than 10% returns. Extend your investment to 8 years and things get better. The probability of loss drops to 0 and the average return stays strong at 12.8%. But again, only 79% of times large cap funds cross the 10% mark. Stretch it to 10 years and your chances of earning over 10% returns skyrocket to 93% with an average return of 12.9%. So as per historical data, we can see that for large caps, 8 years is the stress-free zone where your chances of negative returns become 0. And 10 years is your ticket to double-digit territory. Next, let's look at the mid-cap funds. Mid-cap funds have to invest at least 65% of their assets in mid-cap companies, means the companies that rank between 101 and 250 in terms of their market capitalization, that is their size. Mid-cap funds are obviously riskier than large-cap funds, but with higher risks comes the higher return potential. So how long should you invest via SIP in mid-cap funds to earn double-digit returns? Look at the data on your screen. If you invest for 5 years, there's a chance of losses. The minimum return stood at minus 8.2%. But holding your SIP in mid-cap funds for 8 years and 10 years mitigates the risk, and the chances of negative returns drop to 0. Better yet, in a 10-year tenor, your odds of earning double-digit returns jump to an impressive 98%, averaging 17.3% annually. The results look similar for the 12-year period as well, with a significant improvement in the minimum returns as the tenor of SIP increases. So holding your mid-cap fund investments for at least 10 years significantly increases your chances of avoiding losses and reaping double-digit returns. Next, let's look at the small cap funds, the riskiest ones in the equity space. As the name implies, small cap funds invest at least 65% of their assets in small cap companies, that are companies ranked 251 and below in terms of their size, that is market cap. Small caps come with the highest volatility. These are often the wild cards in the equity market. While they have the potential for high returns, short-term performance can be brutal. Let's look at the data on your screen. 5 years could leave you with a minimum return of minus 21.2% and an average return of 15.1%. If you increase the tenor to 8 years, the minimum return is still negative at minus 6.5% and the average dropped slightly to 14%. At 10 years, there is a significant turnaround with a minimum return of minus 0.4% and an average of 14.6%. Now here 99% of the times the investments give positive returns. But if you stay invested for 12 years or longer, the chances of losing money vanish and the average return stood at 14.3%. While the chances of double-digit returns slightly dip in the 12-year tenor as compared to 10 years. There is a significant shift in the percentage of times when small caps gave positive returns, that is 100% of the time. So for small cap SIPs, consider extending your horizon to at least 12 years to ensure that the wild ride smooths out and losses drop to zero. In short, the longer you stay invested, the more you smooth out risks. There is one more interesting aspect to this. So when you invest for long enough, your starting point, whether you start at market highs or lows, hardly impacts your final returns. Surprised? Let's understand with some numbers. After the recent market crash, a lot of people hit the panic button. Some stopped their SIPs thinking they would lose more money. Others waited for a dip to start. But does it really make a difference? We checked SIP returns when an investor started investing at market highs versus market lows, specifically in the volatile mid-cap and small-cap indices, the Nifty Mid-Cap 150 and Nifty Small-Cap 250. Look at your screen. Come to the medium term first. In the medium term, timing did matter a bit. If you started your SIP in the Nifty Mid-Cap 150 at the low in March 2020, it gave 27.3% returns versus 22.9% if you started at the high in December 2020. But in the long run, the gap fades. The results were the same in the small cap space as well. In the medium term, returns did differ. In the long run, it did not matter much whether somebody started SIP during market high or market low. So don't stress too much about finding the perfect time to invest. Stay invested long enough. Consistency and time matter far more than perfect timing. And it's a wrap. Hope you liked the video. Don't forget to like and subscribe. Also share the video with your friends. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.